All right, good afternoon, everybody. Thank you for being here. So today we're going to be talking about how DeFi has revolutionized TradFi with 24/7 markets on equities, commodities, and FX. In short, RWA on DeFi. So we're going to address the overlapping of blockchain 24/7 real-time infrastructure with the world of traditional asset classes. For example, how can we trade Apple stock over the weekend? How can we trade gold during the weekend? Well, there is a new instrument called perpetual futures, perpetual swaps, that were initially invented for the purpose of crypto trading, and that has now expanded to non-crypto asset classes. So Kaiko, we're a data company. We have been building crypto rates to enable 24/7 perpetual futures for crypto assets. And since then, we have expanded to non-crypto products as well. So we're going to talk a bit about that, the importance of perpetual futures as an instrument, and what it means for traditional finance and real-world assets on-chain. So first of all, when did crypto started? Crypto perpetual swaps were originally an instrument invented by BitMEX probably 10 years ago to be able to trade derivatives contracts on crypto in a perpetual fashion. So perpetual futures became widely accessible through crypto, and they basically enable 24/7 crypto trading. As a derivative instrument, perps also allow crypto market participants to use leverage. The widest decentralized exchange for perps is Hyperliquid, and it enables up to 20x leverage. Perpetual future contracts today dominate crypto trading. If we look at Bitcoin as a proxy, perps represent almost 70% of the total traded volume. Here you can see two charts. There is a chart that shows the evolution, but it also shows that already back in 2024, perps contracts were a very large portion of the crypto volume, and it has increased since then to almost 70%. So perps around the world. Kaiko is working with regulated derivatives exchanges to power 24/7 crypto benchmark rates that is used across the world to power overnight trading and overnight settlements. Here, what you can see is a map of most of the regulated exchanges offering cryptocurrency perpetual futures. All of those are regulated exchanges under different jurisdictions. In the US, you have the CFTC, which is the supervisory body. You have FTA and ESMA in Europe, and then you have MAS, SFC, and other Asian regulator in the APAC region. Most of these exchanges are cryptocurrency exchanges that offer regulated financial products. But the logo that stands out here is Cboe. Why? Cboe is originally a traditional regulated institutional exchange, and they launched last year continuous futures on Bitcoin and ETH. Kaiko is the benchmark rate provider. We'll talk about why data is so important and so critical to perps in a few slides. But so Cboe has launched continuous futures on Bitcoin and ETH, giving institutional investors, the usual Cboe clients, access now to instruments that were previously only available on cryptocurrency exchanges for the cryptocurrency investors. So this was a meaningful step into making crypto as an asset class a more institutionally investable asset class. This and obviously the original crypto ETF listings. But this is really an innovative product designed for crypto that is very specific to the nature of crypto markets, and that was enabled by a large traditional financial exchange. So the Cboe, Bitcoin, and ETH continuous futures are powered by 24/7 independent regulated benchmark rates that Kaiko provides that power the mark price and the funding rates calculations. This is very important because this is the benchmark that you use to define what is the price of any given crypto asset. And crypto is a very fragmented market, right? The same Bitcoin, the same ETH, the same crypto assets that are essentially bearer securities are trading across hundreds of exchanges globally, centralized exchanges, decentralized exchanges. And so addressing a question that should be quite simple. What is the price of a crypto asset is not actually as straightforward as it sounds. So the interesting evolution now, and it's something that I love because it is really a great demonstration of how obviously crypto is bringing new technology, blockchain and DeFi and smart contract logic to the world of traditional finance. But it's not just an innovation for traditional finance, it's also, crypto also provides new sorts of contract and instruments that can be used by traditional asset classes. So what we're seeing here is the initial emergence and then successive growth of non-crypto assets trading on, in this case, it's on Hyperliquid. So non-crypto assets trading using perpetual futures, which was originally designed as a crypto-native instrument. So now, what we're seeing here on the far right side of the chart is that you have about 30% of Hyperliquid trading volume that is now traditional asset markets. I'll give a very recent example, but a very meaningful one. Over the past couple of weeks, when we had over a weekend, the situation in Iran started to escalate, and Trump giving an ultimatum on Iran, which ended up pretty much blocking the transit of crude oil through the Detroit of Hormuz. What we saw is that the actual markets were closed during the weekend. And during that weekend, there was a surge in volume for Hyperliquid's crude oil markets, CL/USDC, which is the one you see on the chart on the right, second right after Bitcoin. And during that weekend, it traded 1.7 billion daily in volume. There was 300 million open interest. It was the second most traded product on Hyperliquid. And it basically was not just a purely speculative thing. It was actually solving a real problem, which was, well, the markets were closed. And when the markets were closed and investors needed to find some place to trade the asset class, they found Hyperliquid, and they found that the perpetual future that enabled kind of this continuous market was a very good instrument. And so that was a very good demonstration of how crypto brought this innovative 24/7 trading aspects into traditional asset classes. More recently, we've seen a lot of existing exchanges, a lot of large institutions, including the CME, including NASDAQ, and CBOE, more recently again, expanding towards near continuous trading, and not just for crypto, right? We're talking about now bringing that to all sorts of traditional asset classes on traditional exchanges. So let's go back to crypto, and then we'll expand to RWA. What does it take to run DeFi perps on crypto assets? What does it take to basically have a Bitcoin perpetual future trading on Hyperliquid? You need a couple of things. You need obviously the right data, the right raw market data that is going to enable you to build reliable benchmark rates. Answering, that's what I said earlier, answering a simple question, but what is the price of Bitcoin? A price that I can accurately trade against, and a price that actually I could even have leverage against, making sure that this price is accurate and accurately reflects the market. So this is why benchmark rates exist. Benchmark rates are actually heavily regulated. There's a regulatory framework called benchmark regulation, and that regulates data providers and benchmark administrators that are going to create financial data products used in regulated financial instruments. So in order to build reliable benchmark rates, you obviously need to have good quality market data. And so the first step is the data, the second step is building the rates, and the third step is actually delivering the data into the DeFi markets. We're talking here about Hyperliquid or, other DeFi perpetual future markets, but it is on-chain. And so in order to build the good benchmark on the blockchain, you need a strong oracle delivering real-time data. Finally, those are real-time trading products that settles every second. So what you want to make sure is that the data that you deliver through the oracle is also tailored for that level of second-level settlement, and that you can do outlier detection and all sorts of risk management within the oracle itself to ensure that there is no accidental delivery of data. So that is what it takes to run DeFi perps on crypto as an asset class. The right data, the right benchmark, the right oracle, and the right risk management tools. Why all of that matters so much? Recently, we've seen, and it's been the case for a long time, but DeFi as a broader industry can suffer immensely from oracle exploits. Why? If oracles, whether they can be extremely robust from a technology standpoint, where they source the data that they will then funnel into DeFi is extremely important. And so there has been oracle exploits. We've listed a few here, but there are more, and it's a clear trend and something you can look up quite easily, where if the source of the oracle can be manipulated, especially if it's a low liquidity market that you can easily move, then you can have very much leveraged consequences on derivatives markets. And so an oracle is important from a technology standpoint, but it is also important to look at what is the data that is being fed through the oracle. So now I want to expand that thought process to building oracles that service non-crypto asset classes. We just mentioned the crude oil market on Hyperliquid. There are equity markets on Hyperliquid. There are commodity markets, volatility markets, FX markets. We're starting to see all sorts of asset classes being listed on Hyperliquid. And so actually building a benchmark rates for a non-crypto asset class is quite different, because as much as it's technically challenging to get the right price of Bitcoin, you know that there is a 24/7 market for all crypto, and that you can pretty much always find a market anytime that will trade crypto. With RWAs, that's not exactly the case, because there are moments, quite often at night and during weekends, and sometimes on days off, where the market is closed. So the first thing you need to do, like with crypto, is access the right data. And if we take the example of an Apple share, which was the original example from the cover, that data feed is owned by NASDAQ. And NASDAQ can license the Apple security data feed during the opening hours of the market. And that is okay. So you need to access the right data. However, when it comes to traditional asset classes, you need to get a proper data license to have the right to use the data. That is one difference with the crypto markets. The second one is, how do you do to build a 24/7 benchmark that has updates every seconds in markets that do not trade 24/7? So here you need the knowledge of building 24/7 rates, both from an infrastructure standpoint, but also from a data benchmarking standpoint. And for that, what we do at Kaiko is that we use proxies from where markets are closed. We use ATS prices. We use futures. We use all sorts of alternative data that give an indication of where that thing trades outside of market hours. With all of those data feeds, we compute a benchmark. And so we go back to the same thing. Once you access the data, you need to build a benchmark that is resistant, robust, and follows the benchmark regulatory frameworks. Then we still need the oracle to deliver the real-time data onto the blockchain. And then you need solid risk management. It's still the same infrastructure questions that we had before. So with RWA, you need the right data. The right data here is different than in crypto, because it very often belongs to exchanges who want to license this data. So you need the right licensing, and then you need the right ability to create 24/7 rates. So what I'm trying to get to is reliability in enabling 24/7 perpetual markets on real-time on non-crypto asset classes is not just about technology. It is actually a lot about the data itself. What is the data that you're going to funnel through to the DeFi market? So I'll talk a bit about Kaiko and like how we build those rates and how we deliver those rates. I mentioned we have the market data. The market data component is really the raw market data. Being able to gather every single tick trade, every single order book updates, every market information you can get on the trading of, in this case, crypto assets, but it can be on non-crypto assets. Then there is building the benchmark, building the rates, building the index. This is another part of what we do. And then finally, data infrastructure under which the oracle component live. The way we approach oracles at Kaiko is quite different to the public Oracle designs that was more tailored to crypto assets in the beginning. Here it is really a bridge between API-based financial data and smart contract execution. We are not a decentralized protocol. We're a heavily centralized, regulated company. And so we really see that more as a data infrastructure business, which is piping the right data, critical market data into the networks, the exchanges, and wherever this data needs to be consumed for an application or a contract. That's our data infrastructure business. We're independent, global regulated, and we are working with about 200 clients globally now, from market infrastructure, financial service providers, buy-side, sell-side, market research, and regulators. So I hope this gave you a bit of a sense of the data consideration in the world of crypto, and in this, I think, expansion that we're seeing from an asset class standpoint of like, what are the assets that live on the blockchain? We, a couple of years ago, were in a world where the assets that lived on the blockchains were crypto assets. And this is an incredible asset class that is now an institutionally accepted investable asset class. We're seeing all sorts of regulated financial products catering for investors wanting to get exposure to crypto as an asset class. But my favorite development of the past 2 years is seeing not crypto being treated as an investable asset class, but blockchain being treated as a new type of underlying infrastructure that can enable traditional financial services, that can enable capital markets, collateral mobility, repo, lending, all of the things that we have experimented on with DeFi and that we've scaled with DeFi can now be applied to all sorts of tokenized real-world assets. And this is something that I find extremely powerful. The reason I wanted to focus on perp markets specifically is because, for me, it embodies that merger of those two worlds, where a very innovative crypto-native instrument leveraging the 24/7 continuous nature of blockchain technology is now applied to traditional markets and providing novel solutions to the existing financial industry. So this is very exciting. Data matters a lot. I do believe that blockchain technology is very mature now. We have, very powerful technologies, very powerful smart contracts, language, design, logic, DeFi applications. We now have regulatory clarity. We're starting to see regulated stablecoins, cash and cash equivalent, tokenized money market funds, tokenized T-bills. We're starting to see all sorts of things being brought on chain. The technology works, the assets are there. What we need to enable applications and trading applications and capital markets application is going to be very accurate, reliable data, and very accurate, reliable data infrastructure to bring that valuable data into the smart contract logic and execution workflows. So that's what we're doing at Kaiko, and thank you for listening, and thank you for being here.